Going to be talking about what's going to be covered here. The purpose of the special series is to share an overview of macroeconomic and monetary policies for maintaining economic and price stability. First part, I'm going to be talking about price stability. This is the most important in this particular part. That's where it will be covered up. There'll be a bit about economic policy also. I'll be talking about unemployment rate. But however, as the module progresses, it's going to be much more larger. There are a lot of subtopics that will be coming in. Now, some of the topics which you could check would be around these lines. So, open market operations is a separate module. Phillips curve, introduction to Phillips curve is a separate module, but it will be covered a bit in this particular module as well. When we are going to be looking today, we'll be predominantly looking at central banks. We look at their mandates. What do they do? What is the major policy rate? We'll see their role as a lender of last resort. This is a separate module also on that. And then we'll be looking at some of the frameworks in managing monetary rates like Taylor's rule, Montague rule. Now the references, as I always talked about, two books from Macroeconomics by Gregory Montague and Mishkin, Macroeconomics Policy and Practice. I suggest you go through also all the macroeconomic modules at the middle road, especially module 7, to understand. So it's very much required to understand when you are understanding stabilization as a whole module, as a whole topic. These are key references and research papers which have come in. This is a very good list of papers. You could read it. Some of them have directly been used, some have been indirectly used. So this is a very good list of reads which you can refer. All the analysis is by the middle road. Nishan Malhotra, I am the owner, the sole funder, and the only employee at the middle road. This is a quick recap. We've seen the short-term fluctuations. Whenever we're talking about short-term fluctuations, the is measured by real GDP. These are recessions and expansions, and these are caused through shocks to aggregate demand and supply. Now we'll see this through a change in the output when rate, price levels. So whenever I'm talking about price levels here, it implies inflation. Now a quick recap between long run and short run. You see aggregate demand. Now in the long run, the aggregate demands impacts price level but not output and employment. In the short term, the prices are sticky. The prices of a lot of products are sticky. Not everything is sticky. So therefore, it impacts employment and output but not prices. We have I think covered before this particular aspect that in aggregate supply in the long run is determined by the amount of capital, labor and level of technology. The production function we had touched about in one of the modules. I suggest you look at it. The aggregate supply curve is horizontal when you're talking in the short term. Central banks are huge enablers. Basically, they set up the short-term rates, they set up the lending rates. They also influence long-term rates. These are rates very important within the whole social impact of whatever you do, whether you're working in a non-profit, whether you're working in a foundation, or whether you're in a business, or you are working in a multilateral bank. This is the deciding force. The economic environment or the social impact environment. The economic environment affects the social impact environment. Look at central bank. One of the key or the major selected functions is to promote monetary and macroeconomic stability. Could have, whenever they have monetary agenda, they could be either dual or hierarchical. So, which is in this case, they would usually have one mandate, but they will also look at a mandate, but that one mandate is the most important. The major factors which they look in is price stability, maximum sustainable employment, which we look through unemployment rate, growth of the economy, and currency stabilization. So currency stabilization among the major bank is followed by People's Bank or Central Bank of China. Now they also promote a sustained and efficient financial system. They implement regulations for a smooth function of the economy and also for a smooth payment system. So these are some of the selected functions, but we'll predominantly look at the monetary aspect today. We have, and you've seen this in predominantly other parts also, why I have kept the other price stability, set interest rates and moderate long-term rates are all monetary policy. The reason why I've kept maximum sustainable employment, because we'll be looking at, when we're looking at Taylor's rule or when we are looking at Phillips curve, this is a very important factor. That's the reason why I have specifically mentioned this is more of a macroeconomic policy. One of the central tenets of a central bank now is lending as a last resort. There are three tools for this particular function which a central bank uses. It predominantly goes to the open market. And when we're talking about open market, there's a special module which you need to refer to have a fair bit of idea what an open market is. So they use it for repo and reverse repo. The other way is that they purchase assets or do quantitative easing in the open market. It's permanent, this part. And the third is they give distress lending to financial institutions when there is systemic risk within the system. Now that could be either the financial institution goes to the central bank or the central bank goes to the financial institution. It could take place in any way. So there's a very good research paper, Central Bank Tools and Liquidity Shortages. I suggest you read it. This is will give you very good, prominently a very good perspective on how about lending as a last resort. Now, when we look at monetary tools, we are looking at temporary money open market operations. That's where we are talking about repo and reverse repo. It's basically used to manage liquidity within the system. You can say reserves within the system, and it is used to adjust short-term rates, basically policy rates like effective Fed funds rates. To just give an example. When you're looking at permanent open market solutions, basically asset purchases or quantitative easing. So this gives you a fair good of idea of both of these operations, whether temporary or open market, and this is discussed in the separate module. We are looking at assets, outright assets purchases. We have Riksbank. This is the Central Bank of Sweden. It is the oldest and one of the most prestigious central banks in the world. Now you could look at the asset purchases over a period of time, which has just gone up. When you're looking at the asset purchases, basically majority of them is domestic securities, which you can see. Now this is just to give you an idea how the banks, if you're looking at a central bank, how the assets have grown over a period of time. This is a very good analysis. So I looked at the total balance asset size of Bank of Canada. So Canada is basically Central Bank of Canada. And if you look at the asset purchases over a period of time, you'll get specifically when the major distress was during the Great Recession, you could see how much has been the purchase during that time. So you see 40.79 has gone from this particular part to the function here, which I've given 78584. So this gives you a fair bit of idea that in 2018, the Bank of Canada had increased asset size by 45.79% from the case of 2008, from the arrow which is mentioned. You a very good idea. And if you look at, and I looked at the graph and I looked at the peak. So if you look at the peak was in 24/12/2008, which is about $81.53 billion. This part is Canadian dollars. It's mentioned here. And if you see how the balance sheet had come up, and then over a period of time as the economy grew, the balance sheet was cut down. So this gives to give you a very good idea of how the balance sheets move over a period of time. This is another graph which I use. It's percentage of nominal GDP is the total asset size of United Kingdom. It's Bank of England. This is another very prestigious bank and also one of the oldest banks, central banks in the world. Very good database. You could go to 3 centuries. They've taken our macroeconomic data, and I think this is a fabulous achievement on part of Bank of England. You could compare prices from 1725 to now. Gives you a fair bit of idea as the explosion of the economy and the population grown, how the balance sheets and how the behavior of the central bank and how it's developed over a period of time. I would suggest that this is one of the best databases you can get. This, if you look from 2007 to 2018 is what I've seen. This is in RMB. It's in RMB yuan billion, and it's 270.1%. So you've seen over a period of more than a decade, just a little bit more than a decade, the increase has been tremendous. When I was talking about hierarchical and the dual mandate, these are the central banks. So whenever you're talking about price, price stability. It could be you're directly looking at price, which we'll look at, or you see a percentage change in the price, which is much more easier to manage. Inflation is actually, whenever you're talking about price levels, the majority of the central banks I've tracked are actually using inflation as the mechanism. So you can see Canada, New Zealand, Sweden, Australia, ECB is European Central Bank. But if you look at the dual mandate, so US and New Zealand have a dual mandate. So they look at sustainable employment and inflation. So there's a trade-off. That's what I was talking about. So they look at both the mandates. In this, inflation is the first target. When they're okay, inflation, they could look at it. But in this dual mandate, they are both of them play a very important role in making decisions. So that's the difference between a dual mandate. When you're looking also as a dual mandate, you have People's Bank of China. It looks at stability in the value of currency. Basically, if you look at stability in the value of currency, it becomes very important because this is a key factor, one of the critical factors, I would say. I'm not sure how much it's a critical factor for China, but for India, and we'll see, for inflation. So this makes sense to a certain extent of why the China is looking at stability of value of currency. Not economic growth. Now, Reserve Bank of India, which is the Central Bank of India, you're looking at price stability and economic.